Today's highest probability move is a short squeeze into 1.1611 if the fragile Israel-Iran truce holds and US CPI expectations soften. But that move is fully priced only above 1.1556. What's priced in right now is a dovish ECB narrative that gets slaughtered on any daily close below 1.1501 to extended analysis. This EUR-USD technical analysis today centers on a multi-timeframe compression where the weekly strong sell trend is colliding with a monthly by structure right at the 200-day moving average. The pivot at 1.1528 has held overnight, but EUR-USD support zone sits at 1.1501 and a break there opens the trapdoor. We walk through gold support and resistance levels linkages, why the dollar is easing, and what real yields are whispering. Traders searching for EUR-USD forecast next week need to see that MACD is deeply negative yet building a hidden bullish divergence on the 4H chart that could ignite a violent mean reversion trade. Every level, from 1.1446 to 1.1611, is mapped with exact entry triggers, stops, and risk-reward logic. 0:00. The trap most traders don't see 1:15 critical invalidation level. Write this down. 3:30. The hidden divergence on 4H that changes everything. 5:50. The sniper conservative plan with levels on screen. 8:10. The aggressor high risk momentum play. 10:00. Tomorrow's wildcard US CPI and the dollar wrecking ball. SEO fluid string. Why is EUR-USD dropping today while the dollar eases? We dissect the fragile truce and US inflation data in view. This EUR-USD technical analysis today covers precise EUR-USD support zone, pivot point, and a potential breakout above 1.1583. If you're looking for a EUR-USD forecast next week, watch the 1.1501 collapse level. Our gold and S&P 500 gamma levels explained link everything to real yields. Crude oil supply shock 2026 risk is also in the crosshairs. Daily 8-asset institutional coverage. 24H global macro view. Smash subscribe and never miss an explosive move before it happens. Risk disclaimer. Trading foreign exchange, commodities, and indices carries a high level of risk and may not be suitable for all investors. Past performance is not indicative of future results. The content provided is for educational and informational purposes only and does not constitute financial advice. Always do your own research and consult with a licensed financial professional before making any trading decisions. 1.4 Thumbnail concept. Bold words on thumbnail. 1.1556 breakout or bust. CPI trap. Free fall zone. Dominant emotion. Trap to breakout. Visual metaphor. A giant euro symbol and a dollar symbol slammed together against a transparent brick wall with the number 1.1556 etched in glowing red. Behind the wall, a ticking clock marked CPI ticks toward midnight, while a dark chasm labeled 1.1501 gapes below. Red and green arrows fight for dominance. A trader cannot scroll past because the image screams a binary event, either a massive melt-up launch or a catastrophic freefall collapse, and the exact pivot level is right there, forcing an immediate what happens next. Curiosity gap. 2. Voiceover SEAP. There is a trap being set right now in the euro-dollar, and 9 out of 10 retail traders are about to walk straight into it. Right now euro to US dollar is trading at 1.1552, up a tiny 11 basis points on the session, but don't let that green flicker fool you. This is not a risk-on rally. This is a fragile truce bounce with US inflation data breathing down the market's neck. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade tomorrow. And I promise by the time you finish this video, you will understand why the number 1.1501 is a line in the sand that separates winners from the herd. Let's set the instant market verdict right now. The session bias is fade the rip, but with surgical caution because we are hovering right on top of a pivot that could snap violently. The weekly trend is a strong sell, the daily trend is a strong sell, the 5-hour and 1-hour trends are both in sell configurations. That is 4 time frames screaming lower. But here is the twist. The monthly trend is still a buy, and price is currently coiling inside a multi-month value area. So we are not in a freefall trend. We are in a pullback within a larger bull cycle that is approaching an exhaustion zone. This means today's move is either going to be a fake-out breakdown that reverses with a vengeance, or a genuine collapse that accelerates stops below 1.1501. My single invalidation level that flips everything is 1.1501 on a 4-hour candle close. Write this number down. If we break and close below 1.1501 today, the entire daily structure resets and we target 1.1473 and then 1.1446 without hesitation. If that level holds, we are looking at a mean reversion trade back into the 1.1611 resistance cluster. The herd is short, heavily short. I've seen retail positioning data, and the majority is leaning short expecting an immediate breakdown on the CPI fear. That heavy short positioning creates a coiled spring. If we don't get a clean breakdown, those shorts become fuel for a squeeze. That's the trap. And market makers know exactly where the buy stops are sitting above 1.1556 and 1.1583. So watch those levels like a hawk. Let's go into the technical deep dive. And I'm going to walk you down from the weekly chart all the way to the 60-minute, because the alignment is rare and dangerous. On the weekly chart, we have a clear rejection pattern. Price failed at the 1.1700 area weeks ago and has been carving lower highs ever since. The 20-week moving average is sloping lower around 1.166 something, and the weekly MACD is in freefall below the zero line. No signs of flattening. That tells you institutions are selling rips. Drop down to the daily chart and you'll see the moving averages are stacked bearish. The 5-day moving average at 1.1554 is right here where price is currently, so we are literally fighting right at the short-term sentiment line. The 10-day is at 1.1574, and the 20-day is at 1.1610, all above us. But the most important line on the daily is the 200-day moving average sitting at 1.1589. That's the line that has acted as a brick wall multiple times. Right now price is below that 200-day, meaning the structural bias is bearish. The RSI on the daily is 39, not yet oversold but weakening. The stochastic at 29 is starting to curl but not crossing. And the daily MACD is negative, with the histogram still printing lower bars. However, here's what most traders miss. On the 4-hour chart we are seeing a potential hidden bullish divergence forming. Price has made a lower low near 1.1505 while the 4-hour MACD histogram has made a higher low. Hidden divergence in a downtrend means the trend might be running out of steam and a correction could be explosive. The 4-hour 200 period moving average lines up closely with the daily 200 at 1.1590, so any bounce is going to have to fight that zone. The ADX on the 4-hour is at 37, which is very strong. That means the trend is powerful, but when ADX is that high and price starts stalling at support, a sudden reversal can be brutal. Now zoom into the 60-minute chart. The 60-minute MA stack is also bearish, but price is starting to coil around the 1-hour 20 period MA. On the 60-minute MACD we have a bullish cross just starting. The Williams %R is at -72, still deeply oversold but lifting. This tells me there is short-term momentum trying to push higher, but it's fighting the bigger picture. The volume profile shows a high volume node right at 1.1528, the pivot point, which is acting as a magnet. So all this compression is going to release soon. Support levels are crystal clear. S1 at 1.1501, S2 at 1.1473, S3 at 1.1446. Resistance, R1 at 1.1556, R2 at 1.1583, R3 at 1.1611. Your trade location has to be precise because the ATR is only 53 pips. You cannot be sloppy. The range is tightening, and that means the breakout, when it comes, will be violent and fast. Now let's connect the fundamental driver and cross-linkage because yesterday's fragile Israel-Iran truce changed everything for the dollar. The dollar eased off its highs as safe haven flows unwound slightly, giving the euro a small lift. But that truce is paper thin, and the real monster is the US inflation data looming. The market is pricing in a sticky CPI scenario, which would push Fed rate cut expectations further out and send the dollar screaming higher. If that happens, the euro will not simply dip, it It will collapse through these supports because the rate differential between the ECB and the Fed will widen again. The ECB is already dovish, and any hot CPI print cements that policy divergence. The bond spread between the German Bund and the US 10-year is widening in favor of the dollar. When that spread gaps, euro-dollar follows tick for tick. Right now the spread is near recent lows, correlating perfectly with this downtrend. If we see a softer CPI number, that spread could snap back violently, launching euro to US dollar through the 1.16 zone. Gold is also reacting to the same real yield dynamic. Gold sell-off yesterday with the truce news tells you real yields are driving everything. If gold breaks down further, expect the euro to follow, because both are anti-dollar plays. The Nasdaq futures and S&P gamma structure show a market that is also tense ahead of CPI. A risk-off flush would be dollar positive, euro negative. So the cross-asset linkage is screaming, watch the dollar index. If DXY clears 105 on a closing basis this week, euro to US dollar will not hold 1.15. That's my directional lean for the next 1 to 2 weeks, bearish while below 1.1611, but I am highly alert to a bull trap short squeeze if 1.1501 holds and CPI comes in soft. The exact event that invalidates a bearish view is a daily close above the 200-day moving average at 1.1589, confirmed with a follow-through above 1.1611. Do you think the dollar breaks 105 this week? Comment yes or no below. I'm tracking consensus, and the last time we did this the yes camp nailed the move. And now we get into the trade setups, and this is where most viewers drop off. But let me tell you, most people skip this section. That's exactly where the money is made. Keep watching. I'm giving you 3 sniper level plans, complete with exact triggers, stop losses, and risk-reward ratios, and I've designed them to work whether this thing melts up or free falls. Strategy 1, the sniper, the conservative play. This is for the patient trader who wants a high probability bounce. Here's the setup. We wait for a 4-hour candle to close above 1.1556, that's the R1 pivot, with a simultaneous bullish MACD crossover on the 60-minute chart. This confirms that the intraday structure is flipping. The entry is on a retest of 1.1556 after the breakout, with a stop loss placed at 1.1500, just below the S1 support and the critical daily level. That gives you a tight 56 pip stop. First take profit target is 1.1611, the R3 resistance and the 20-day moving average, for a first risk reward of roughly 1 to 1. Second target is 1.1655, the 50-day moving average, extending the R multiple to 1 to 1.8. What voids this setup entirely? A 4-hour candle close back below 1.1501. If that happens, the structure is broken and we cut immediately. The sniper, conservative, entry, 1.1556, for H close above, retest, stop loss, 1.1500 take profit 1, 1.1611 take profit 2, 1.1655 risk, reward, 1 minute and 1 second, 1:1.8 hour invalidation, void if 4H candle closes below 1.1501. Strategy 2, the active trader. This is a standard mean reversion play for those who want to trade the range without waiting for the breakout. The trigger condition is a dip into the 1.1510 to 1.1505 demand zone on the 30-minute chart, accompanied by a bullish divergence on the 30-minute RSI and a hammer candle rejection. You enter long at 1.1510. Stop loss is placed at 1.1470, just below the S2 support, giving a 40 pip stop. First target is 1.1556, which is a quick 1 to 1.15 risk reward. Once that first target is hit, we move the stop to break even and trail it manually using the 15-minute 20-period moving average as a dynamic exit. The second target is left at 1.1583, the R2 resistance. This setup plays the mean reversion bounce off strong support with a trailing stop rule that locks in profit as momentum builds. But this strategy voids itself if we see a 30-minute candle close below 1.1499, indicating that bids are not absorbing and the breakdown is real. Type your euro to US dollar range for tomorrow in the comments now. Give me your high and low. Let's see who's aligned with the institutional levels to the active trader. Standard, entry, 1.1510, 30M bullish divergence plus hammer, stop loss, 1.1470 take profit 1, 1.1556 take profit 2, 1.1583 risk, reward, 1 minute and 1.15 seconds 1:1.8 trailing stop. Move to break even after TP1, trail 15 MMA 20 invalidation. Void if 30M candle closes below 1.1499 strategy 3, the aggressor, high risk. This is for traders willing to chase momentum on a breakdown. If we get a 15-minute candle close below 1.1501 with a volume spike and the VIX futures ticking higher, you enter short immediately at market on the break, targeting the flush. Entry at 1.1498 after the close. Stop loss is tight at 1.1520, just above the pivot, at 22 pip stop. First target is S2 at 1.1473 for a 1-to-1 ratio. Second target is S3 at 1.1446, giving a 1 to 2.3 risk reward. This is a pure momentum play, and you must accept that it can reverse sharply if the breakdown fails. Only for those who can lose small and manage risk aggressively. If price snaps back above 1.1528 within an hour, the trade is invalid. The aggressor, high risk, entry, 1. 1498, 15M close below 1.1501, volume confirmation, stop loss, 1.1520 take profit 1, 1.1473 take profit 2, 1.1446 risk, reward, 1 minute and 1 second 1:2.3 hour invalidation. Void if price recaptures 1.1528 within 1 hour. Quick risk management pulse, 30 seconds. Never risk more than 1 to 2% per trade. No positions through high-impact news like the CPI release. Stops are non-negotiable. This is how you survive to trade the next big move. Protect your capital first. Profits are a byproduct of discipline. Let's close this out and set the retention loop. If there is one number you take away from today, it is 1.1501. That is the level that holds the entire euro-dollar structure together. Tomorrow's focus is the US inflation report, and I will be live with a breakdown of the real-time reaction, showing you how to navigate the spike and avoid the stop hunts. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen and see why BTC is tracking the S&P like a shadow with a massive gamma flip. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one, ready for the volatility before it hits.